So I'm going to talk about what the coronavirus crisis has done to first to the labour market and then to household incomes, and then what policies the government has introduced to try and reduce those impacts. So I'll be covering, first of all, the nature of the economic shock, a little bit on the role of policy, then we'll go from the labour market through to thinking about household incomes. Then I want to argue that looking at household incomes alone is not sufficient to understand the true impact of this crisis on households. We need to look at spending and their balance sheets in particular, and I will conclude. So it's very easy to come up with lots of superlatives at this point, but we have obviously seen a massive, unprecedented, enormous shock to the economy, and unlike previous crises, rooted in the labour market and also very sectorally differentiated. And this chart here shows the change in GDP in different sectors of the economy. This is change in overall levels of economic activity. The blue line is the change in the first lockdown last April, and the red line is the change as of November, when England was in its second lockdown. So very, very large, even in November, and concentrated in certain sectors, as we know, leisure, hospitality, retail, although the actual categories used by the ONSA don't quite match those perfectly. And then when we trace that through into the labour market, what it means is that the kind of workers who typically work in retail, hospitality and leisure have been most likely to have been affected. Sorry, I should have said at the start of my talk that my talk and the slides you're seeing are drawing on several pieces of work done at Resolution Foundation over the last 10 months. Most of the analysis is drawing on Understanding Society, a couple are drawing from some surveys we collected ourselves. This one is drawing on Understanding Society, and it's data from there, from the COVID sweeps that Understanding Society did, and this one is from the first lockdown, just looking at which sorts of workers saw their employment patterns disrupted by the pandemic, whether they were put on furlough or lost their job altogether or had their earnings cut. And amongst those who were in work before the crisis started, as we know, the initial shock was bore more strongly upon younger workers and also a little bit upon the older workers. If we look also at how that affected low wage and high wage workers, as we do in this chart, we see that low wage workers not only got the sort of biggest employment hit from the crisis. Well, what I'm showing here is a proxy for that, which is that the blue line is showing you what fraction of workers with different wages worked in those sectors which were, have had the most severe restrictions during this crisis, and they are predominantly found at the bottom of the wage distribution. In yellow or yellow browny color, we're showing the fraction of workers, probably people like us, who are able to work from home, and that's concentrated amongst high earning workers. And then in red, as I say, the low wage workers not only facing the biggest shock from the economic shock from the crisis, they also tend to be facing higher health risks. So in red, we're showing the fraction of workers who are in industries that face higher health risks through exposure to COVID, or being in customer-facing roles where it's harder to socially distance. So the crisis had an unequal impact in the labour market. We've looked also at other characteristics. Now, again, this is data from the very beginning of the lockdown last April and May. At the top, you can see there is quite a significant variation by ethnic groups, and particularly it seemed that some ethnic groups were especially likely to lose their jobs altogether, which is marked in red, rather than being furloughed. That will also relate, of course, to the slightly higher rates of self-employment amongst some ethnic groups compared to the white group. Not much difference, at least in the first lockdown, between men and women on average. That is in part because quite a lot of women women are overly represented in key worker jobs and the sectors that kept carried on going. Men are overrepresented among self-employed, who definitely took a bigger hit than employees. So not much difference between men and women overall, but as many of you will be experiencing right now, really quite a big difference between mums and dads, or mothers and fathers, in the fraction who are having their work disrupted because they are also homeschooling. So this is from the first lockdown, and just showing the fraction of parents who say they've been reducing their working hours because of childcare responsibilities during the crisis. And we know, of course, the commensurate impact this has on mental health. Yes, very complex. So that was just a quick tour through the labour market implications of the crisis, started towards the low paid. What we've been interested in is how that affects the distribution of household income. So we've got to go from thinking about earners and where they are in the earnings distribution to where people are in the overall household income distribution. I'll talk through the slide in a minute, but the punchline really is that not all low earners are in low income households. Not everybody in a low income household is in a low paid job. So these charts are from work we put out a few weeks ago, where we are coming to our own assessment of how the crisis has affected people at different parts of the income distribution. And we're drawing on a number of surveys, including Understanding Society. So on the left-hand side, it's a similar kind of chart to before. We're showing the fraction of those who were in work who have been affected by the furlough scheme or have seen losses in their self-employment business. And amongst adults who are in work, you can see that the impact is indeed concentrated towards low-income households. So if you were in work on a low-income household, you're more likely to have been affected by the crisis. But many adults in low-income households are not in work at all, and so they can't be affected by the labour market shock of the crisis. And this is reflected in the right-hand chart, which is showing amongst all adults in households how many have been directly affected by the labour market shock of the crisis. So it is still slanted towards the bottom of the income distribution, but it's not. It doesn't peak at the very bottom of the income distribution, because at the very bottom of the income distribution, there are quite a lot of non-working adults. And I should have said all of this is actually among the working age population. So this is not pensioners getting in the way here. This is just thinking about working age adults who are not in work. So still skewed towards the bottom, but not dramatically so. And then a few slides on policy. Again, this is the time to bring out all of your superlatives, but the policy response from the government to this massive economic shock were some unprecedented support schemes, unprecedented both in their size, but also in the speed of development, invented in a couple of weeks last March. The two key ones being the job retention scheme or the furlough scheme, which pays up to 80% of your previous earnings, and the other one being the self-employment income support scheme, grants to self-employed, also providing up to 80% of previous profits, although with quite a lot of restrictions and exclusions, which we might come back to. And of course, what I didn't write here was the £20 increase in universal credit, which is also very, very important. But these two new things, the job retention scheme and the self-employment income support scheme, I think no doubt we'll be looking back at those when the crisis is over and asking whether the fact that the government introduced them means that our welfare state was inadequate. But certainly there are the important features of the JRS and self-employment grant scheme contrast dramatically with the existing welfare state. These new schemes are earnings related. Traditionally, our welfare state has provided flat rate income support, so the same amount to everybody, doesn't matter what your previous earnings were, and with a heavy reliance on means testing on your partner's income and the amount of capital you have. Again, features not found in these new schemes. And these two new schemes, the JRS and self-employment grant system, have played a huge role in protecting households from the shock in the labour market. So this is another traditionally very complicated resolution foundation chart. What we're showing in the black dots and the green bars is replacement rates from before the crisis. Sorry, replacement rates. Start again. What the chart is showing is replacement rates. A replacement rate is looking at how much income you would have if you fell out of work as a fraction of the income you would have in work. And we look at the combined income of the family. The black dots with the green bars show these replacement rates if you lost your job and claimed benefits, or with the black dot being the median replacement rate. So across the entire population of employees and self-employed workers, if they fell out of work or lost their self-employment business and had to claim welfare benefits, then their family income would be just over 50% of what it was when they were in work. Remember, we are looking at the family income, so it's including that of any partner as well. The yellow dots with the purple bars show replacement rates under the job retention scheme and the self-employment grant system. So the question we're asking there is, what if everybody was put onto the furlough scheme, or all self-employed people were able to claim the self-employment grants? And replacement rates under these systems are much higher, so over 90% for the typical replacement rates. So they've made a huge difference in protecting those people who've been able to claim them from the employment shock. Although, of course, as I noted earlier, we know certainly for the self-employment grant system, there have been issues around people being excluded through the various eligibility rules. Okay, so then what we've just done in recent work is try to think about how that labour market shock plus all the various support systems combine to and ask what they mean to the distribution of household incomes. The big picture story intimating is that while GDP has suffered a massive hit this year, that's the blue line. You can see the dashed blue line falling dramatically in 2020 and then gradually regrowing in the years after. That has seen dramatic swings. The fact that we've had these support systems means that typical household incomes, at least as is looking at household income at the median in red, have hardly been affected during the crisis years. And in fact, the story is even more nuanced and perhaps even more surprising when we look across the whole income distribution. So the blue line is looking at what we think it's looking at the difference between levels of incomes in the current financial year to levels of incomes in the previous financial year. And in our latest nowcast, it came out a few weeks ago, we actually think that incomes at the bottom of the distribution are higher than they were at the bottom of the distribution last year. This is, of course, due entirely to that £20 a week increase in universal credit and working tax credits. And it is surprising, it is a little bit surprising, but it is perfectly consistent with what I was showing you earlier. So we know many people have seen incomes fall and they will be falling down the income distribution. But the fact that the government has put up benefits at the bottom and that benefit rise goes to 6 million families, that is sort of overriding that at the bottom and means that actually incomes at the bottom of the distribution this year should be a bit higher than they were last year. But then if we look forward a year, that will be the yellow line. The yellow line is showing what we think will be the change in incomes in the following financial year compared to the current financial year. Then we see really big falls in income at the bottom. And that is because that's because the government are still due to stop the £20 a week uplift at the end of March. That's still their current policy. And it's also because we are expecting a rise in unemployment next year if the government goes ahead and stops the furlough scheme at the end of April. So together, those two policies would mean that incomes at the bottom distribution would fall very substantially during the next financial year, leading to what we think will be one of the largest rises in relative poverty we've ever seen year on year. And I just skipped that slide because I think I'm running a little bit behind. But what we have argued also is that in this crisis particularly, it's just not good enough to look only at household income. We need to think about the whole household balance sheets and think about how spending has changed and how savings have changed. Sorry for my flickering screen there. We know overall that spending has fallen considerably, so that the top two lines showing that by the third quarter of 2020, household spending was down by about 10% compared to the year before. And obviously this varies enormously by type of spending. We're spending considerably less on transport, on restaurants and hotels, and on leisure, recreation and culture. But that's not been felt evenly across the whole income distribution. So in a survey we commissioned in September last year, funded by the Health Foundation, we asked people how their incomes had changed since when the crisis started, but also how their spending had changed since when the crisis started. And we put the two together to come up with this sort of three-way typology of families that are feeling squeezed because their income has fallen more than their spending, or indeed their spending has gone up on an unchanged income, which is something I showed in research at the start of this year. That's in red. And then the other, at the opposite, is the families in green, who are referred to here as loosened. So for them, their spending has fallen, but they're fallen by more than their income, or more typically, their income is unchanged, their spending has fallen. So that's boosting their financial position. And you can see the gradient here. So basically, if you came into the crisis on a lower income, you're more likely to be in that squeezed bucket. If you came into this crisis with a higher income, you're more likely to be in the loosened category. And I think that's a much better way of thinking about the distributional impact of this crisis so far. We can see it also in data directly when we ask people who is saving more than they were before the crisis started. About 20% of people told us they were saving more than they were before the crisis, and this matches aggregate data, where we know that saving rates, and the aggregate saving rate is much higher this year compared to last year. But that increase in saving is coming overwhelmingly from better off households. The opposite of that is that there are families who say they are having to borrow to cover everyday costs. Now, some of the levels in this chart look a little bit high. So this is what families told us when we asked them whether they were having to borrow or get support for everyday costs. But so the levels are a bit high, but the distribution, the gradient seems entirely plausible and very sensible, and it's skewed towards lower income households. So I think, so I argue that I think that's gives us a much more rounded view there of the impact of the crisis. And let me just go quickly to my my final slide. The story so far is there's been a big hit in the labour market, skewed towards the young and low earners, but in part because of the government support scheme, it's so far a fairly muted change to household incomes overall. Of course, notwithstanding, there will be some families who've seen really big falls, but across the distribution, not much change so far. But we would argue that in this crisis in particular, it's really important to pay attention to what families are spending, basically because the government has sort of stopped us spending in various sectors. And that has different impacts on high and low income families, depending how much they were spending before the crisis started on things like hospitality, leisure, and holidays. And it's this interaction between how spending has changed and how incomes have changed, which leads to this really regressive impact, an inequality enhancing impact of the crisis so far. So we see higher income families strengthening their balance sheets on average, lower income households more likely to take on debt. And certainly, the longer the crisis goes on, the more worrying this looks, and the weaker our eventual recovery will be. And as we've said many times, the Resolution Foundation, the government then just faces really key decisions in the next few weeks about whether to continue with a £20 a week uplift to benefits. That will make an enormous difference to the situation for low-income families over the next few years. And also when to time the phasing out of the furlough scheme, the job retention scheme, where their current target date of the end of April does look to be a little too soon if they are to avoid a spike in unemployment and a deterioration in household circumstances next year. Thank you. I'll leave it there.